Okay, so first of all, the strategy name is London Range New York Session Open Breakout Strategy, New York Open Range Breakout. We also call it as New York Open Range Breakout. Preferable currency pairs are currencies and CFDs to trade are GBP US dollar, British pound US dollar, Euro US dollar, and gold. Okay. Step one is analyze the chart between before pre-New York Open, which is 12 p.m. GMT. Your time is 6 p.m. GMT plus 8. Okay, in your time. Mark down the intraday London highs and lows on 15-minute time frame and refine it on 5-minute time frame. Okay. How about step 3? Step 3 would be can you tell me?
Draw Y-cost structure.
Yeah, draw Y-cost structure on 15 minutes time frame and refine it on 5 minutes time frame. Okay. All right. And then step 4, identify the bias based off Y-cost structure drawn. Okay. So what's next? Can you tell me?
No, sir.
Hold on. Okay, so identify the bias on structure. Okay, identify the bias based on Y-cost structure. Okay, drawn in step 3. Okay, observe the bias in 3 key areas. What are those key areas? As I told you, London intraday high, London intraday low, and London intraday range. Okay, what is London intraday range? London intraday range means between highs and lows, between London intraday high and low. Okay, got it? Any questions so far? Step 5. Now we go for step 5. Now for the step 5 we have, once you are marked down, right, then we will draw and mark. Sorry, identify and mark. Identify and mark Y-cost schematics. Okay, on 5 minutes time frame. Step 6. Okay, step 6. What will the step 6 here? Execute trades on 3 minutes time frame. Okay. All right. Now one more thing which I have to do is a tip here is a special tip. Okay. Draw vertical line, dotted line on London Open. Okay. And draw vertical line on London Open, vertical dotted line on London Open, New York Open, pre-open, and New York Post. Got it?
Okay.
Because okay, the difference between London session, like a London Open and this New York Open, is that New York Open is divided into two parts: New York Post Open and New York Pre-Open. That's the difference. Okay, this is a tip here. Okay. Tip number 2. Okay, this is tip 1. Tip number 2 is draw. Okay. Look for entries at or after pre New York Open and post New York Open. Got it?
Okay.
Okay. These are the entire. So this is the guide, the rough guide how to trade, right? Okay. So we're going to start now. Okay. The first thing is analyze 15-minute charts. Okay. So let's go here on screen and let's switch. Which asset do you prefer here? Should I go for euro dollar, GBP dollar, or XA US dollar, whatever before. So let's go for GBP US dollar. 15-minute time frame. We already analyzed this one, right? So we go for the 20. This is 20 May. 21 May. So 20, let's go for 20 May. Okay, this is 20 May, right? Friday. So 19 May. Let's go for 19 May. Here, right? So your time at London Open was 8. Oh, sorry, New York Open was this one, right? So draw the vertical line. You go here on this part, you see line part here. Go here, you will see the vertical line. Okay, and you draw at this one at around 20, right? The second one would be drawn at 9 o'clock your time. This is second line, right? All right, if you want to test it out, you can just write it down just to identify much better. We call it as new your pre-New York Open. Pre-New York Open. Okay, pre-New York Open. All right, and how about this one? Let it make it more smaller. Okay, pre-New York Open is here. You can see. And how about this one?
New York Open at 8 p.m.
This one is post New York Open, right? Load. Okay, post New York Open. Pre New York Open, post New York Open, and then how about the London Open? Your time? Can you tell me? 3, right? This one.
3.
This one. So we just again here. Okay. London Open. Pre. Okay. Now from here to here, between a 15-minute chart, can you identify highs and lows? The lowest is obviously this one, right?
Yeah.
You draw the line here, extend it just past beyond it, right? Just extend it beyond the post New York Open, right? Just extend it, right? Okay. So this is what we call it as. Can you tell me? Intraday London low, right?
Yeah.
And how about intraday London high just before it? This one, just before 15 minutes before the pre New York London Open was this one, right? This one, 1945, which is 7:45 your time. So the highest point here was this one, right?
Yes.
So we call this what? We call this as post sorry, intraday London high. Okay, got it. And now we draw the Wyckoff structure here. Can you draw the Wyckoff structure from here to here? If you see the past market here, what do we notice before London Open? What kind of market do we notice here? We have a downtrend, a little bit accumulation. The price went up. Okay, jump across the creek. Can you see? Jump across the creek, right? And then what happened? We came back, tested this region again, and then we went up. Am I right? So this is LPS,
Okay.
right? London Open is the LPS. Am I right?
Yeah.
Right. Okay. So you already know this, right? The basic structure of the Wyckoff. Now, what are you going to do here? As you go down, this LPS and the price is going up, right? So if we can draw the structure from here. So this one, as compared to this one, is the first higher low. This is also first higher low. This higher low, this higher low, they all are in the same point. Okay, if this is a low, the first higher low is from here. This one, and this one. All of these three come in the same point. So we can draw from here because we are observing the intraday London high, right? So we can draw the structure from here, extend line, connecting these two lows. Now what we have to do? Now we clone it, okay? And we just extend it right. All right. Now what we do? We go to the 5-minute time frame. Now we refine it, the Wyckoff structure. Okay, we define the Wyckoff structure here. So between intraday high and low, what do we notice here? If this is buy, it's a selling climax, secondary test, lower high, jump across the creek, and this one is LPS. Am I right? So if I mark it, selling climax, because if you draw the trend channel here, this would be overbought, the shortening of thrust, right? Selling climax, our automatic reaction, just right over here to the top, we can say automatic reaction. The range has formed already, right? This one is what? Tell me, this one. Secondary test.
Secondary test.
Right. How about this one? LPS, sorry, not JAC, jump across the creek, right? And this one here, it came back and broke through this channel, right over here at the London Open, right? At the London Open, it just came back right over. So what do we notice here? LPS, right?
Yeah.
Now we have intraday high and low. Okay, we have intraday high and low between London Open, right? So what do we notice? Obviously, this is so between intraday high and low. What do we notice here? It is uptrend. Am I right? The channel is here. So we can only say the reversal will happen once we observe the overbought. Am I right?
Yeah.
Okay, so right now we are not overbought. Okay, we are between pre-run and high, right? Okay, so now we have a 5-minute time frame. Okay, this is LPS, and then after LPS we have again like we have a quick drive up, right? And as we go up and up, right, this is again LPS, right? As we go up, last point support. Every time we make a bounce, it's LPS. We make higher highs, higher lows, LPS. LPS, last point support. Okay, LPS, last point support, right? Every time we make higher lows, it's LPS, right?
Yeah.
Yeah, why? Because why this LPS? Because if you draw the channel here, you can see we exactly came over here. LPS, LPS. This one here, when we draw this, we extend this channel here as we drop here. Can you see? This is LPS, right? LPS. We broke through it, jump across the creek, LPS. Jump across the creek, LPS. Okay, and then we have double bounce. We do not jump, but we're getting this LPS, right? Because we have not reached the overbought of this channel. Okay, and now what you're gonna see here? Now during a London Open, pre-New York Open session was here. Where was the pre-New York session open? We go to the 3-minute time frame now. Once the pre-New York session opens, we will go and see. Okay, the session here. Okay, it was right over here. Now tell me, between high intraday high and low, what is our bias?
Bullish.
Bullish bias, right? Between high and low, right? So once we reaches over here, right? Okay, we see here LPS, we have this one here. Now as we come down here, what we see? No demand bar. Can you see decreasing volume? As we come down, the volume is decreasing here. Now as we come down here from this to this point, let me mark from here. See here. And what do we notice here? Declining volume. And this is what do we notice here, this one? After period and open. No demand, no supply. Am I right?
Yeah. Yeah.
No supply. Okay. So we have a no supply over here. So we call it as NS. No supply. Okay. At this no supply, the next part, because we don't know where this no supply will end, right? It can go further down. So we cannot take a trade because we don't have any entry point. We don't know where to place a stop loss. If we take the trade right over here, we don't know whether to place stop loss here, because we don't have a low. But after this, we have a bullish bar. Can you see? The spread has increased, volume has increased. Okay, this is 2-bar reversal, 2-bar bottom reversal. You see increase in volume right over here. So we would take an entry right over here. Stops now. Where is the low? The last low. Last low is this bar low, right? So you can place a stop loss right over here. And now we can target the intraday high, London high. Okay. Got it?
Yeah.
So that's 3.49. So this trade lasted for almost 30 minutes. Okay, and we made 3.49%. But if you do it in gold, you would achieve much more risk to reward ratio. Got it? Because gold moves faster than other currency pairs. Okay.
Okay.
Now what do we see here? Now within this, now this trade is executed. Now what do we see here? Can you see here that at the price just before the breakout, I told you that when the price is breaking out, we can have a pre-breakout. Like we can have a pre-breakout build up. For example, the price is just moving like this. Okay. And then just before breakout, the price just congested pre-breakout trend, right? And the price will break out up, right? This is known as pre-breakout build up. I think I told you in the previous session as well, right?
Yeah.
Okay. So what do we notice here? The same thing occurred over here. We have a pre-breakout build up. Now, can you tell me, here we have a high volume, and here, which side has much more higher volume? This one or this one? Upside or downside?
Down.
Right? And you know, this bar goes up and then closes on the low. So this is bearish bar. This bar goes up, goes down. This is a key reversal. Can you see this bar, this small bar? At first reversal, key reversal. So which one has more volume, this bar or this bar? Which one has more volume,
Blue
this one or this one?
The blue one.
Okay, this one, right?
Yeah.
So obviously, which one has more pulling power, the buyers or sellers? From this,
Buyers.
the sellers have more pulling power. And after this, what we notice? This is again, we see the price came down and then it rejects and closes up. The volume is increased. Can you see here? Right? And now,
Yeah.
but we do not have any effort versus no result or something like that. Okay, because the spread of this bar is greater than this one and volume is also increased. So we do not have any kind of effort versus no result, something like that, right? This one here is also no demand, you can say. No demand, right? But it did not come on the reference line. Did it come on the reference line?
No.
No, so we cannot take this trade, right? But this came exactly on the reference line, right? Right?
Yeah.
Right?
Yeah.
And now, what happened after this? What did you notice here? No supply, right? This is our point where we can enter a second trade before New York Open, right? We will not enter the trade right now until we see a New York Open. Now, after NS, what do we see? Jump across the creek of this pre-breakout buildup of this small range, right? JAC. Now, can you tell me our bias? JAC, can you see? As the price breaks out this trading range, the volume also increases. The spread also increases. Okay. You see here?
Okay. Okay.
So this is jump across the creek, right? And as we come down here, what do we notice? The price went back, rejects, and close on the high. Can you see? Close on the high. And see the volume. So this is seller's volume, right? This is buyer's volume. Because if this was seller volume, the price would close right over here. But where did it close? On the high. The price comes back, rejects, and then price moved and closed up. And there's increase in volume. This is seller's volume, right? And then after this, we can call it as what? Effort versus no result. So we can either enter on this point or we can enter on this point. This is no supply. Got it? We have two entry opportunities.
Okay.
So now we will enter, let's suppose right over here. Our stop loss would be placed below this one, right? And what our target would be? Our target would be the overbought line of this, right? So we draw the vertical line. This is the vertical line, overbought, right over here. Our entry was here, let's suppose. Okay, we entry was here, and we can target all the way to this high. All right.
Okay.
Right. Okay. Now, after a while, we only observed overbought right over here. And you see very huge volume on the top.
Yep.
Right. Okay. This is huge volume on the top, and then we can see that after this, the price declined. Okay, and make another structure. Right. Okay. This is first high low. So now, after we observe the overbought, what do we see here? Okay, let's suppose it's overbought here. Okay. This is our what do we see? Overbought plus buying climax. Okay. How about this one? Secondary test. Okay. This one, AR, right? Okay, AR. Secondary test is also what? Has a one quality, which is lower high, right? Secondary test is also lower high. And once we notice this secondary test was lower high, what I told you, we can draw a small trend line over this one. Okay, we can make it dotted line, as I told you before. Now, once we enter this trade, once we enter this market, what do we notice here? The price went up, decline is what? UT, right? Up first.
Yep.
UT. And now with this UT, what you can do, you can execute your trade. Stop loss would be right over here, and this is okay, 3.17. But the problem is you would be targeting this point, right? This low. How would you know where to exit? If you target this low, we would just come back and we'll make a loss. Then what are you gonna do in this point? Why? Can you tell me?
Hmm?
Can you tell me what to do now? Or if you join these two one here, and if you just draw another channel from here, what do we notice here? The price right came back here, a slight oversold, and then reversed, right? We can exit right away.
Yeah.
Okay. All right. So this is the point. So what we are going to do, I just going to take 3.96 R, which is this one, 3R, and I would exit my trade. Okay.
Okay.
All right. So do you understand the setups here?
Yeah.
Any questions so far?
Not
So
yet.
right now, I'm just explaining your strategies. Later on, I will refine your strategies, because if you notice here, one more thing. This was an AR line. If you can notice here, this was an AR line, right? Okay. On this AR line, once you broke out, what do we notice here? A very small bar, but see the spread, volume. This is what effort versus no result. This gives us an indication that the price would fail. Because if it was a true breakout, the spread will increase and the volume would also increase, right? The volume is increased, okay, the volume, but spread is very low. So this gives me that there are buyers coming, and you see where it's closing of the highs. It's not closing on the lows, it's closing just in this point. So there are buyers coming over here. That's why we have a huge volume. The spread is very small as compared to this bar. The spread of this bar is small, right? Got it?
Yep. Right.
Yeah. So if you have a structure, you would know where to exit, where to enter, right? Where to exit and enter. And you see, this comes right at this channel. Okay, if you join these 2 points, this come right at this channel. And now, once we broke through it, we know that we have to exit our trade practically. Okay.
Okay.
And now, what happened? Now, before we went up, right, we see that the price is just normal, right, average. It goes up. Okay, it tests this AR line, right? AR was here. If you just, sorry, AR was right over here. This one AR, right? Okay, it tests the AR line. Okay, it goes up. But what do we notice here? The volume is very, very average, right? And the price went up. The spread is increased. As you compare this spread bar, if you compare this spread, the bar, spread of this bar with these local bars, the spread is increased and volume is also increased.
Increasing.
So it means that this is actually the price direction will go up, right? We have increased buyer. And now here we have, what do we have here? This point. Can you tell me? Effort
no
versus
result.
no result, right? So it shows us that the buyer, that the commitment of the buyer is that buyers are more stronger. And we can draw the line over here, just right over here. And once we broke down, what do we see? At this reference point, what do we see? Fake momentum. The spread is increased, but volume is decreased. So this is a fake move by the sellers. So it means the buyers are active, right? So we can make and go for the short trade. Our stop loss, this one would be this last low. So we can just place a trade stop loss right over here and target what? We can easily target the last OB and this one because the price may test OB and reverse, right? So we can just target that. Got it? And this is what exactly happened. The price test the OB and the reverse. Right? Do you understand?
Okay. Yep. Yep.
Yeah, okay. So let's go for another one here, XE USD, 15-minute time frame. London session is much more easier to trade than New York session because in New York session you have to take care of more things, right? Like we have to take care of the intraday high and low and intraday session high and low, and we have to take care about the pre-session or pre-New York Open, and we have to take care of post New York Open. We have 2 entry points. That's why this is just a little bit complicated. Much more, it is much more complicated than London session. But as you practice more and more, you will get used to it. Okay.
Okay.
All right. So let's go for this market here now. Let's come for 2019 May. 19 May. Where was the London Open here on 19 May? 3 p.m. which is this one, right? This is London Open. How about the New York Open? Pre-New York Open?
8 p.m.
With this one here, pre-New York, 8 p.m. And how about this one, post? This one, right?
Right.
Yeah. Now, have you noticed every time, whenever there is a New York Open, pre-New York Open, the volume increases. Whenever there is a New York Open or post-New York Open, the volume increases. Can you see?
Yeah.
Whenever there's a London Open, the volume increases. Why? Because the traders become active during this time. Okay. Now, can you tell me intraday high and low between these 2 points? Very easy. This one is the lowest point.
Yep.
And how about the highest point? Highest point before London. This is post New York Open or pre New York Open. So highest point before it is this one.
Yeah.
Right. Very easy to identify. Okay. And now what we have to do? Now we have a range between these 2 points. The bias is what?
Bullish.
Bullish bias. Okay. And now What do we do? As a London Open, we go to the 5-minute time frame, refine it. Okay, quickly refine it. Where is it? Okay. What do we notice here? The price is going up and up, right? Okay. This is what do we notice here? As the price is going higher and higher, just before it, we see a pre-breakout build-up. Can you see? A small range towards this, between this. And then exactly at this point here, we have a huge volume, right? And then you what to say? At this point, the pre-New York session opens, right? We have increase in volume, but we don't have a reference point. We cannot buy over here. We cannot buy sell over here. We need to buy at this point or this point, reference points, right? And now what do we see? We come down. What do we see? What happens to the sellers? Decreasing volume, decreasing spread. And then what do we have here at last point? No supply at this point. Effort versus no result. Small spread, huge volume. What does it tell you? Who is more stronger, buyer or seller? Sellers are weaker than buyers, right? Sellers are weaker than buyers. And then what happened? The price dips down below this low and immediately reverses and close above. This tells you what? This is key reversal, right? This is key reversal. And now you go to the 3-minute time frame and refine an entry. We refine an entry here. Okay. Now it's much more clear. So what do we notice here? This one. This is what? Spring. Am I right? Spring.
Yeah.
Now in this spring, what do we see? Here as well. Huge volume here. But here you see which volume is more stronger. This volume or this volume? Which is more stronger? Buying. This is buying climax. This is selling climax. Which is more stronger volume? Which one has more stronger volume? Buying climax or selling climax? This is selling. This is buying climax. This is selling climax. Both have huge volume. But which one is the more stronger? Selling climax, right? You see, selling climax is more stronger than the buying climax. So we will call it as what we will call it as FBC. Okay, FBC means failed buying climax. Okay, this failed buying climax. This is what selling climax. So this is what automatic rally. Okay, and this is what we have what here automatic rally, secondary test, right? And then this is what spring. After spring, we take the position. Easy. We take a position, pay a stop loss here, and then we target the intraday high, which is this one, right? We target the intraday high. Just 1.84, just make it up. This is achieved. We are done for the trade. 2 hours. Okay, I have to make the video again. I have to call you again because my time is less than 1 minute. Okay? Thank you. Okay. Hello.
Yep. Okay.
Okay.
Yeah. Okay.